Good morning. Thank you all so much for joining us. My name is Hope Carlson. I'm a principal and lead advisor here at Dowling & Yankee, and I'm delighted that today we have with us Will Beamer, our President and Chief Investment Officer, and Mark Wernig, our co-CEO. Thank you so much, Mark and Will, for being here. Will is, in addition to being our President and Chief Investment Officer, also a principal and lead advisor with the firm. He holds a degree from Duke University and an MBA from Harvard University, Harvard Business School. He also has the Chartered Financial Analyst and Certified Financial Planner designations. And many years ago, he was a surface warfare officer in the Navy, as was Mark. Mark is a graduate of the U.S. Naval Academy and the U.S. Naval War College. He also holds an MBA from the Rady School of Management at UC San Diego and the Certified Financial Planner designation as well. And he was named to top 40 under 40 in financial planning by Investment News, a national award. Today, as we dive in, we're going to be spending about 25 minutes at the outset speaking about markets and the economy with Will, and then we'll turn it over to Mark for an update about CI Private Wealth for about 15 minutes. Thanks to all of you who are joining us live or via the recording. If you are live with us and you would like to submit questions during the presentation, you can use the Q&A button. We will field as many as we have time for. If we are unable to get to your question today, we will follow up with you after the webinar. In addition, you're welcome to reach out to your lead advisor. And thank you as well to all of you who submitted questions in advance. So, Will, let's get started. Why does everything feel so bad right now?
Well, first of all, I want to thank everybody for joining the webinar today. I know these are we're going through some fairly difficult times in the investment markets, and I think to answer your question, Hope, a number of different sort of points to address, but kind of maybe starting with the non-investment related thoughts. I think maybe coming out of the pandemic, all of us maybe had what now appear to be unrealistic hopes that there would be some sort of return to normal post-pandemic. We've all sort of had a rude awakening that has not been the case. We may be through the worst of the pandemic, but certainly a lot of other news headlines have taken over. We all struggle, I think, to varying degrees with an omnipresent media, whether we're talking about traditional media or social media. I think that feels like it often has a very negative bias to it. There's political polarization. And then we're also dealing with a really tough geopolitical backdrop right now. So whether most obviously Russia and Ukraine and Vladimir Putin sort of wielding his nuclear saber, which is always frightening, and things we haven't really given a lot of thought to since the Cold War. China and Taiwan, another tough situation. What's going on in Iran, and then moving on to the investment landscape, and we'll talk a lot more about inflation, but we're grappling with the highest inflation we've seen in the economy in 40 years. I think one that probably hasn't been talked about enough is this year we've seen stocks and bonds have significantly negative returns simultaneously, which I think for those of us familiar with investments kind of feels like a violation of some unwritten maxim that when your stocks are bad, at least you've got your bonds to kind of hold up the portfolio, and that hasn't really been the case this year. Traditionally, bonds have hedged equity risk very effectively. And then finally, not to pile on, but it's been a long time since we've seen a really prolonged downturn in financial markets. We obviously had the COVID experience, which was very fast, a very rapid downturn, but bounced back pretty quickly. And I think there is fear that this time won't be so easy. We're already, we've suffered through most of this year, coming from what were essentially all-time highs at the beginning of the year. We had a bounce during the summer, but we're right back down to the lows, and people probably saw that as of yesterday, The Dow Jones Industrial Average is now officially in a bear market, which is down 20%. So I won't go on because that's probably enough for us to deal with. But I think that's a big chunk of why things don't feel so good.
That makes a lot of sense. So can we return for a moment to one of the pieces you mentioned, which is bonds? People have been asking, my bonds are going down. What's really going on here?
Yeah, no, great question. And it comes back to, I mean, for many years now, myself and you, Hope, and Mark, and all of our other lead advisors have really struggled with the question from clients about, gee, I sure wish my bonds paid me more income. Well, I have good news and bad news. The good news is your bonds do now pay more income. The bad news is that the journey over the last 9 months or so to get to this point has been very painful. So Hope, if you can bring up, I think we've got a yield curve slide. But I was looking this morning, there are a couple ways to take risk in the bond market. You can buy bonds that are longer maturities, longer duration, or you can add on to the credit risk and buy less credit-worthy issuers. But if we just focus on the Treasury yield curve, so what you see here is if you were to buy bonds, the blue line is as of last week, and the gray or black line is at the beginning of the year. These are the yields that were available at various maturities from 3 months out to 30 years. And what we've seen is a massive jump, especially, well, at all parts of the yield curve, but especially at the short end. So just to pick one point on the curve, and my numbers are a little bit different, but a 2-year Treasury 1 year ago, back in September of last year, yielded less than 0.3%. It was actually 0.29%. I looked at it this morning. I think on this chart, it's 408. This morning, it was 430 on a 2-year Treasury. A 10-year Treasury, on this chart, at the beginning of the year was 190. I looked at it a year ago in September, it was 148. This morning was closing in on 4%. It was 3.97%. So as most of you probably know, when interest rates or yields go up, the price of existing bonds goes down. And that's simply, it's simply the idea that if you're trying to sell your bond that maybe has a coupon rate of 2%, that 2% coupon is not nearly as attractive to a new buyer today. And so they're going to pay you a lot less for that than they would have, say, a year ago. So that's really what has happened. The last thing I'll mention, and we're going to talk more about inflation in the Fed, but the Federal Reserve really controls the short end of the yield curve. So you've probably heard of the Fed funds rate. That's the interest rate that probably gets the most attention in the media. That's the one the Fed actually manually controls. It's really the overnight lending rate between financial institutions or banks. The longer end of the curve, once you get out to 10 years, 20 years, 30 years, is really controlled by the market. And that's the buying and selling of bonds. And that's generally done based on people's expectations about economic growth, about inflation. So we've seen both pieces of that in the last year or so, the Fed raising the rates at the short end of the curve, and the market pricing in a higher rate of inflation going forward.
Thanks, Will, for that. Can you talk a little bit more about inflation? What is going on with it? Why is it such a big issue?
So let's start with, this is a tough thing to pinpoint, but what caused the inflation that we're seeing today, which I think at last look, if you look at the consumer price index over the trailing 12 months, it was somewhere north of 6%. It's hard to pinpoint a single precise reason, but if you think back to the COVID period, we saw a massive amount of both monetary stimulus from the Federal Reserve, as well as fiscal stimulus from Congress. And so it took a while for that to kind of feed through the system. For a while, that simply replaced a lot of the economic output that was lost, especially in the early days of the pandemic, when we were all staying at home and not out driving on the freeway and going to movies and traveling. But as the economy returned to normal, there's still a lot of kind of pent up stimulus that has now sort of fed into the economy. And I think when you pair that with a lot of the bottlenecks that occurred within supply chains, you simply had a situation of too much money chasing too few goods and services. And so that's kind of the classic definition of inflation. So why is inflation so bad? We could talk about this we could probably have our own webinar just on this topic, but I'll give you three quick reasons. The first is probably the most obvious, that inflation erodes purchasing power. So if you have $100 and inflation is 2%, and you don't spend that $100, well, next year you'll still be able to buy $98 of goods and services. If inflation is suddenly 8 or 10%, well, you're only going to be able to buy $90 or $92 worth of goods and services a year from now. So that's one reason. Inflation also has a disproportionate impact on lower income consumers, primarily because the mix of goods and services that they consume tends to be on necessities, things like food, transportation, could be gas, could be bus fare, train fare, etc. And they're not able, like higher income consumers, to necessarily cut back on discretionary items when inflation takes hold. And then I think the third and most important reason that we really try to prevent high inflation rates is when inflation sets in at high levels, it can really feed on itself. So once expectations that inflation is going to continue to be an issue at higher levels, say 5-10%, something called a wage price spiral can take hold. Workers start demanding larger wage and salary increases. Employers pass on those costs by raising prices on goods and services. And I'm reading a little bit into this, but my belief is that this is kind of what the Fed began to see late in 2021, when some people may remember it abandoned what it was calling transitory inflation. It sort of had this point of view that, oh, well, this is just a passing thing and it'll work itself out. They abandoned that language late in the year, and that's right about when they started embarking on these rate increases.
So, from that perspective, can you talk more about what the Fed is doing and what policies might be needed to turn this around?
Sure. So one thing I think it's always helpful to remember is that the Fed actually has a dual mandate. It is not their only job. It's not their only job to control inflation. It's also their job to do the best they can to maintain full employment within the U.S. economy. But on the inflation fighting specifically, they have two tools at their disposal. The first is the one that gets by far the most publicity these days, which is the Fed funds rate that we've talked about, which again is that overnight lending rate between banks. The second, which first really became an issue back in the financial crisis back in 2008, 2009. Is really the size of their balance sheet and what they do. Back in the financial crisis, they started buying treasury bonds. They started buying mortgage-backed bonds, other asset-backed securities. The idea was really to inject more dollars into the economy. If they bought those things, that injected cash into the economy, and that was more stimulus. They're now moving from what was, that was called quantitative easing, and they're now moving towards quantitative tightening, which is really, selling or at a minimum letting those securities roll off of their balance sheet, letting them mature, which means cash actually comes into the Federal Reserve and is sucked out of the economy, which is anti-stimulus, if you will. Because unemployment, if there's a good news to this whole situation right now, it's that unemployment is still very low, under 4%, I think 3.7% at its last reading, which actually gives the Fed some runway to raise interest rates and keep them elevated to get inflation under control. I think based on the comments at the last Fed meeting, they're not under any illusions that this is going to be a painless exercise. As interest rates go up, borrowing and investment will likely drop. Companies will likely stop hiring or even lay off existing workers. I think that I believe that the recent projections the Fed put out had inflation increasing by about 1% over the next year, which equates to about 1 million people who would be put out of work from today's employment levels.
So, given the actions the Fed is taking, how long do you think inflation is going to be at these high levels? Will the Fed's actions work?
Yeah, having control of the Fed funds rate is a very powerful tool that the Fed has, but it's also a very blunt instrument that takes time to work its way through the real economy. So the real question is not whether higher interest rates will bring inflation down. We firmly believe that it will, but I think it's more about how precisely the Fed can navigate this narrow and precarious path that's called the dual mandate. If they move too quickly or if they keep rates too high for too long, then there's increasing likelihood that they'll drive the economy into a recession, perhaps a severe recession, and much higher unemployment. And this is the so-called, there's a lot of distinction between the soft landing and the hard landing, and that would be a hard landing scenario. Most, from what I've read lately, most market prognosticators think the probability of a recession in 2023 is probably higher than 60%. Somewhere I've seen as high as 80 or 85%. I always take those kind of with a grain of salt because to me, recessions are just a part of the market cycle. We've been through recessions, we'll be through more recessions. I think what matters more is how deep those recessions are, and I think that really remains to be seen. One last thing I'll say on this, Hope, is there is some maybe it's not evidence, but at least an indicator that the market is pretty confident that the Fed will succeed in controlling inflation, and probably in the relatively short term. So that indicator is called the break-even inflation rate. So put simply, this is the inflation rate, the future inflation rate at which investors would be agnostic between buying regular US Treasuries or what are called US Treasury inflation protected securities, commonly referred to as TIPS. Currently, the 10-year break-even inflation rate is about 2.4%, which suggests that we're likely to see inflation come down pretty dramatically from current levels.
That's helpful. Thank you. So some hope perhaps ahead. One of our clients had a good question that was, don't fight the Fed has been ongoing guidance for a while. Are we just going to be treading water until rates do start to come down?
Yeah, I always love these investment maxims that are maybe they work most of the time, but the exception, I guess, maybe proves the rule. Sell in May and go away is another one of my favorites. Based on history, there's no reason to believe that we're going to tread water until someday magically the Fed starts cutting rates. Financial markets are forward-looking. They don't simply reflect what's happening right now. They're discounting the future, and a certain number of Fed rate hikes are already anticipated by the market, and therefore they're baked into stock and bond prices today. So that doesn't mean there won't be dramatic moves in the market going forward, but those moves will result from changes to current expectations. For instance, if the Fed ends up hiking more or less than anticipated, or stops their hiking campaign sooner, or extends it longer, but not from the simple fact that the Fed is currently in a rate hiking cycle, which is already known. So I've actually got some, it's probably beyond the scope for today, but I've actually got some historical information that sort of shows that there's really not much difference between investing in equities when the market is hiking versus when it's not.
Interesting. Well, on the bond side of the rate hikes, another question from the audience, is there a silver lining to these rate hikes? Can we increase income by adding bonds to our portfolios?
Absolutely. I think I referred to this earlier as kind of my good news, bad news, that we're in a much better spot as it relates to bonds, but it was painful to get here. So if you think back a year ago, there was a popular expression in the investment world. And actually, one of our partners, Jake Erlinson, and I were talking about this yesterday. That expression was "there is no alternative," or TINA, which basically meant that bond yields were so low that one had to allocate, or perhaps even over allocate, to stocks in order to get any satisfactory return. That's no longer the case. So when you look at high quality intermediate term bonds, they're paying about 4%. Intermediate term investment grade corporate bonds are closer to 5%. And perhaps most important, if we compare that to, we talked about that break-even inflation rate of being about 2.4% over the next 10 years. So if you compare those yields of 4 or 5% to the break-even inflation rate, bonds are actually offering a couple percentage points of real inflation-adjusted yield for the first time in many years. So I think that's absolutely a silver lining. As a corollary, though, it's not necessarily great news for the stock market. If the stock market benefited from the TINA environment, because if there's no alternative to stocks, it means a lot more people invest in stocks. If conversely, now we're in a situation where there isn't a valid alternative to stocks and people can be okay with a couple percentage points above inflation, and that will help them meet their long-term goals, then they may reduce their allocation to stocks. So, remains to be seen how that plays out. But I would suspect that over the recent months that we've probably seen some people start to rethink their allocation.
So to that end, as we're getting questions from folks about, hey, should I rethink my allocation? Under what circumstances would you say, yes, it's worthwhile to shift a little more towards bonds? Do you advocate any kind of tactical moves that way?
I'm generally not a fan of tactical moves just based on what's going on in the market. I think if, back to goals, and this is where, our lead advisors and our financial planning team come in. If someone is able to meet their long-term financial goals with a more conservative portfolio, then I think it makes sense to do that. But it's not simply reacting to, oh, gee, I can get more yield on bonds today, I should change my portfolio allocation. I think it has to be done in concert with evaluation of someone's goals.
Thank you. Can we pull up for looking at the overall market and the economy? Are there some historical parallels for us to learn from?
I think so. Although I never, as the expression goes, history never repeats, but it often rhymes. So I think I don't think there's one single historical era that is the be all and end all answer for what's happening today. But there have been a couple that I've thought about quite a bit. If you go back to the late 90s, when we had the kind of internet economy starting to take off and a lot of .com stocks. Some of you may remember pets.com that would ship you a 50-pound bag of dog food and with no shipping cost, some very sketchy business models back then. So there was a lot of froth in the market in 1999 and 2000. I think there was a lot of froth in the market in late 2021. And I think, I don't know if you can pull it up now, Hope, but I think we may have a stock that shows, some of what's happened to some of those investments from 2021 that, maybe don't look quite as great today. So, ARC Innovation is an ETF run by Kathy Wood that invested in a lot of sort of technology disruptors. Shopify, you've got Zoom, Netflix, and Peloton, sort of your COVID pandemic darlings, when all of us were staying at home and watching a lot of movies and riding our Pelotons. Bitcoin, all of these things are down from the beginning of the year, 58 to 79%. So, I think, we really didn't get caught up in this. I've also got on here just for reference, a Bloomberg bond index that's down 13.75%, and the S&P 500 was down over 21% from the start of the year. Certainly nothing to write home about, and it's been incredibly painful. But some of these areas of the market that were really, praised by the press in 2021 have taken huge hits. So that, to me, that is somewhat reminiscent of the froth that we saw in the late 1998 to 2000. The other era that comes to mind is the late 70s and early 1980s, when the economy was really going through what became known as stagflation. So both high unemployment and high inflation. So as I mentioned earlier, we're fortunate so far that we are not dealing with a high unemployment situation, but it was a painful period on the inflationary front too. And Paul Volcker came in late in the Carter administration and was kept on by Ronald Reagan when he was inaugurated, and really made it his sole mission to break the back of inflation, which did cause a severe recession. I remember, my parents having mortgages in the mid-teens in around 1980. So by comparison, even at today's higher rate of 6.5%, it looks like a bargain. And so, you think back to that Volcker period, it did send the economy into a recession, but it also set the stage for an enormous bull market in stocks that really lasted until 2000, as well as bonds. And so, as much as this reset is painful, it could lead to good things going forward.
So with all that in mind, what should people be doing?
Well, for Dowling and Yankee veterans, it probably won't surprise them to hear that my first answer is that often doing nothing is the best answer, and to sit tight, not panic. As we talked about quite a bit, I think the silver lining here is that bonds are in a much better position to produce income and help people meet their goals in the long run than they were, say, a year ago. I think one temptation that I see people having right now, with regard to bonds specifically, is that they want to pick that sort of highest yielding part of the yield curve, say 2 to 3 years, and really focus on that. And there's nothing wrong with having exposure on that part of the yield curve. But I also think that if we do go into a period where, a couple of years from now, inflation is under control, perhaps slow growth is again the real problem, and rates may start coming down pretty dramatically, you will have wanted to stock up on some longer dated bonds, some intermediate term bonds as well. So being able to buy a 10-year treasury bond at close to 4%, I would encourage people to look at that, as well as the 2 to 3 year part of the curve where they can get maybe closer to 4.5. We also have some exposure to corporate investment grade bonds, which I at least thus far, it looks like, I think unless we have a really severe recession, I think that will hold up pretty well. Municipal bonds look very attractive, especially for, I know we have a lot of California-based high-income taxpayers. So California intermediate muni bonds are yielding about 3%, which if you're in the highest tax bracket is greater than 6% tax equivalent yield. Some might say, well, what about these municipalities? Aren't they all going to go bankrupt? They're actually in better fiscal shape than they have been in a long time. They've added to rainy day funds. They benefited from a lot of the federal and state stimulus that came down during COVID. So I wouldn't worry a whole lot about credit quality for municipalities. Let's see. We do sometimes get asked about investment strategies for times of high inflation. The kind of common answers there are, stocks actually generally do okay during inflationary periods. Real estate, especially if you're able to raise rents, is a good place to be. Treasury inflation protected securities, obviously, will at least help you keep pace with inflation. Commodities, some would even say gold or precious metals. But my one sort of caveat here is I would be careful again that if the market is correct and inflation does come back down in, say, the next 12 to 24 months, there is a danger in over allocating to these sort of inflation defensive asset classes. So just a note of caution there.
We shift gears for a minute and talk a little about the international picture. Some folks have said, boy, why should I invest in any kind of international stocks? The geopolitical situation plus prices seem kind of a mess. What's going on there?
Well, there's no doubt that there are a lot of messes globally. And we haven't talked about the strength of the dollar, but the dollar against a basket of global currencies has appreciated something like 15% this year. We're basically I think we're above parity now with the euro. We're approaching parity with the British pound. So one reason that foreign stocks have had such poor performance this year is not necessarily their performance in local currency, but a big contributor has been because of the currency exchange effect. So if you look on the right side of this chart, you can see that the Morgan Stanley All Country World ex-US Index, that's a mouthful, but it's basically all stocks outside the US, is down almost 23% this year. About half of that is because of the actual stocks going down in value in their local markets. And about half of that is because of the currency return, because the strength of the dollar and the fact that those local currencies have weakened against the dollar. So, I think, actually, I think we have one other slide on foreign stocks, on valuations. So the world is kind of a mess right now. There's not much doubt about it. And as I said, the strength of the dollar isn't helping. But international stocks also look very, very cheap relative to US stocks right now. So on the left, we see price to earnings discount, which if you look at a 20-year average, the S&P trades at about 15 times and the foreign stocks traded about 13 times. Well, today the S&P is pretty close to its historical average, but the foreign stocks are down to 11 times, which is about 2 standard deviations as far as that differential goes, about 2 standard deviations below average. And we also see it in dividend yields. So dividend yields on US stocks versus or on foreign stocks versus the US are almost 2 percentage points higher. So and I hope you and I were talking about this a little bit yesterday, that as much as a mess the world seems like it's priced to be even a greater mess than it actually is. So this, in my opinion, now is not the time to abandon international diversification.
Let's shift gears yet again and talk a little bit about the overall approach. One question that we hear in a lot of different forms is market timing. Can you talk a little bit about what it is and why it's so seductive right now?
Well, my quick answer is it's seductive because in the short term that selling your equities, which seem to be going down every day, and going to cash will stop the pain. And I get it. That is very seductive. The problem is that it's really, really hard to decide when to get back in. And if your back to your long-term goals, whether they're retirement or something else, if your long-term goals depend on getting some inflation-adjusted return, then sitting in cash probably is not going to be the answer. And so that means that you have to decide when to get back into either all equities or into some sort of balanced stock bond portfolio. And that's a really hard decision to make. So I think a lot, when I ponder this question, I think a lot about my experience with clients back in 2008, 2009. And, I think that was, at least so far, that was an even scarier time than what we're seeing today, because the future existence of our financial system was very much at risk. And so we saw Lehman Brothers fail in September of 2008. And then it seemed like every weekend there was another major financial institution in jeopardy of failing. And it took a lot of stimulus and bailout money to make that problem kind of resolve itself. I had clients who took a lot of clients who took some sort of action. They cut their equity exposure, they eliminated their equity exposure. In some cases, they terminated our relationship. But in almost no cases did they get back into the market before the market was above the point at which they got out. So the market started to rebound in March of 09. It did so very quickly. I think there was a tendency, especially for these people, to write that off as kind of a head fake and it wouldn't last. And then suddenly the market was up 50 or 60% from its lows in March of 09. So I absolutely have empathy and I understand why people are tempted to want to go that route, but I just think it's a really, really tough thing to execute.
So a related question perhaps from the audience, can we talk about how long a downturn typically lasts and what's ahead? How would this time be any different?
Yeah, I come back to sort of first principles on this question. And, if we, as market participants, if we believe in the long-term power of capitalism and that people will want to invest in companies and the companies will go out and do their best to earn profits and pivot their companies as necessary, and unfortunately sometimes need to lay people off as necessary to get closer back to profitability. And when times are good, they will expand their businesses and hire more people. So as long as those impulses and those foundations of capitalism are still in place, then I think this is just another temporary setback on a long sort of steady ascent of market capitalism. So in terms of, I think we have one more slide, maybe, Hope, that shows kind of upturns and downturns, if you will, throughout history. And I think that the really good news here, the positive markets are in blue and the negative markets are in red. There's a lot more blue than red on the screen. And as painful as these periods are, and they really don't end up lasting all that long historically. Don't pay too much attention to the Great Depression. That was probably the one big exception to that rule. But mostly you see pretty big pronounced upturns and blue mountains on this chart. So again, I think the next step here is really starting to get some data in that the Fed is getting ahead of inflation. And then I think the market will turn at some point, and it's important that as investors that we be there when it does, because it can move very quickly upward when recovery gets underway.
Very helpful. So parting thoughts, what is Dowling and Yankee doing and what are we not doing?
Yeah, and I'll keep it, I think we're maybe running a little bit behind, so I'll try and keep this quick. I think the important themes are that we're staying disciplined. We're really trying not to let emotion get in the way of sound, evidence-based decision making. We're looking for planning opportunities. So when you have these kinds of sell-offs, that can, where asset values turn lower, that can create some planning opportunities. We are doing a fair amount of trading. That's really primarily driven by rebalancing to our strategic asset allocation for each individual client. It was kind of interesting in the first few months of the year because stock and bond returns were kind of moving in parallel to the downside. There wasn't a ton of rebalancing that needed to be done. But as stocks have now gone down quite a bit more than bonds, we are doing a little bit of rebalancing there. And then we're doing a lot of tax loss harvesting. So just as we did back in 2020 or 2008, our hope is that many of our clients will have realized losses for 2022, which should improve their, at least on that front, improve their tax bill relative to 2021. Another one that we're doing, but also I would encourage clients to look at this in their banking relationships, is evaluating our cash positions. So very safe, ultra short bonds, whether they're treasury bonds or something else, money market funds, are now paying significantly more than most bank deposits. Not all bank deposits. There are a few banks out there that are paying attractive rates, but a lot of the big money center banks have not kept pace with what's gone on in the short-term bond market. So worth looking at. If you have large bank balances, that's worth looking at. We've adjusted our capital market assumptions, which we normally don't do mid-year, but with the sell-off in both stock and bond markets, we've adjusted our expectations for returns going forward upward. And then I mentioned planning opportunities, but refreshing financial and retirement plans, looking at gifting opportunities, Roth conversions, paying down variable rate debt is a big one. If any clients out there have variable rate debt, you might want to take a fresh look at that and look at the opportunity of paying that down. Won't surprise anybody, but we are definitely not doing is trying to predict or time the market. Talked about that a little bit. We're not overweighting, underweighting particular parts of the market. Again, that sort of equates to market timing. And there's a great piece by Howard Marks a couple of weeks ago on financial forecasting. And it's really easy to turn on CNBC and sort of fall prey to what the talking heads are saying or what one particular financial luminary is saying. But the data suggests that most people are really bad at forecasting, even the so-called experts, and nobody ever really holds them accountable for the failed predictions they've made in the past. So we're not paying a whole lot of attention to that.
Thanks so much, Will. This has been very helpful. I'm going to turn it over now to Mark Wernig, our co-CEO, to talk a little bit more about CI Private Wealth. Mark, hello. Can you refresh our memory? What is CI Private Wealth?
Well, thank you, Hope, and thank you, Will. Really appreciate those comments, and thank you to everyone that's made the opportunity or created the time and space for this update today. Just as a refresher, it's hard to believe it's been a little bit more than a year since we've had the opportunity to codify this strategic partnership with CI Private Wealth. So certainly grateful for the chance to provide an update. As background, and forgive me if I'm repeating myself from prior updates, but CI Private Wealth is just that, a partnership that has a parent company in CI Financial. So CI Financial, a global asset manager, wealth manager, headquartered out of Toronto, currently overseeing more than $250 billion in assets, again, globally, Hope, on behalf of more than 10,000 clients. And CI Private Wealth, under that parent company, is a private partnership focused exclusively on investment management, financial planning, wealth management here in the United States, and comprised of 26 previously independent individual firms throughout the United States. What I will add, just as a refresher as well, is that what truly makes CI Private Wealth unique in its offering is the partnership model, which is a bit different than you would see in other potential strategic partners, specifically in our space. CI Private Wealth within that partnership is actually in a position to afford its employees an ownership stake in the company. The reason we find this especially interesting and valuable is that it does a great job of actually aligning interests with our clients and of course our partner firms to do what we do best, and that's maintain our entrepreneurial spirit as fiduciaries on behalf of our clients.
Mark, thanks so much. And we have the full map up on the screen now with all the other 25 sister firms with us. Can you talk a little bit about them? Our audience probably knows a good bit about Dowling & Yonke, but may not be as familiar with who some of these other firms are. What are they like?
Thanks so much, Hope. I'm really excited to talk a little bit about it. And forgive me, I know it's a bit of an eye chart to see all those firms, but as Hope mentioned, DNY is now partners with 25 additional firms, as you see throughout the United States. So you see the Northeast, the Mid-Atlantic, of course, the Southeast, the Midwest, the Northwest, and of course, San Diego represented in the Southwest on behalf of CI Private Wealth. And really what this allows us to do is focus on the expertise that exists within each and every firm of CI Private Wealth. We're going to talk, and I know we're running a bit over our limit, a little bit about the talent contained within this partnership in the form of committee work and how a lot of our partner firms are working collaboratively to solve for enhanced solutions on behalf of our clients. So you can see that represented here. So it's essentially, in my opinion, the best and brightest in our industry coming together to form something truly, truly unique.
Can you talk a little bit more about why we're so excited about this partnership? What is that additional value that we're seeing?
Absolutely. I think the reason we're so excited, I'll boil it down to what I think are three high level themes. Certainly at the top of that list is our clients. So the opportunity to create unique or expanded opportunities for our clients that currently don't exist within DNY as a single office is very, very interesting. The ability to use our collective size on behalf of CI Private Wealth. Imagine Dowling and Yankee, which is grown meaningfully in over the course of the last 3 decades, negotiating as a $6 billion firm versus now, perhaps $120 billion of assets nationally, is creating nothing but value over the last year. We're going to talk a little bit about that. And the third, I would say, is the expansion of our team. So the ability to introduce permanent capital as we have in a strategic partnership really allows us to plan not only for the decades to come, but I would say perhaps even over generations to come on behalf of our clients.
So, to go a little deeper, what's changing and what's not going to be changing?
Hope this is timely. And for anyone that has received an email from Charles Schwab in the last couple of weeks, I think that's just about everybody on this call. There has been some changes and a few more to follow. Our team has been very, very judicious, thoughtful in terms of how we're managing that change. I'm often reminded of one of my favorite Winston Churchill quotes, to improve is to change, but to be perfect is to change often. Certainly no one is perfect, but it doesn't mean we ever stop striving to be that for our clients. So to summarize, Hope, back-end administrative processes have certainly are evolving. That was the email that everyone received showcasing that Dowling and Yankee accounts with Schwab have been migrated over to the CI Private Wealth umbrella for precisely the reasons I just talked about, how we can deliver additional value. Co-branding is coming soon. This is something our team has been working on over the last 6 months or so. I'm very, very excited to introduce a co-brand between CI Private Wealth and Dowling and Yankee in the early part of the 4th quarter, as soon as October. And even more services for our clients. So certainly we haven't had the opportunity to get into the details of what that could mean, but a couple of partnerships have actually come to fruition over the first year of our partnership with CI. And I'll name one. Certainly Parametric as a direct indexing solution for our clients, Y charts as an analytical tool for our trading team and advisors. The list I imagine will continue to get built out over time, but certainly all changes that are great for our clients in the future.
So what's not changing?
That is as we talked about, Hope, leading up to this strategic partnership with CI Private Wealth, there were certain non-negotiables, and I will say 1 year later those are still non-negotiable. So what's not changing, of course, is our fiduciary model. What I'm most proud of when I look at this chart of CI Private Wealth throughout the country is our 25 sister firms are just that. They are also fiduciaries. So imagine, the opportunity to continue to prioritize, as we always have, our clients' interests. That, of course, is paramount. Our investment philosophy, we build portfolios today as we did a year ago, as we did 30 years ago, using low-cost, diversified portfolios that are specific to each individual's client risk mandate. So that certainly doesn't change, nor will it. But I do think, the opportunity to potentially enhance that offering through the strategic partnership you see located here, the expertise that's contained within many of these firms will be value adds over time. And lastly, I'd say the third thing that certainly will not change that non-negotiable is the team that our clients have come to rely upon. We take a lot of pride in not only establishing that team, but building trust over time. Really, the redundancy in place is not coincidental. This is absolutely by design. And quite frankly, it's meant to obviously serve our clients in any dynamic market environment, just like the one Will described.
What else should we know?
Well, I got to tell you, only one more quote when it comes to what else we should know. And I think of John Wooden and when he says, good things take time. And I think that's exactly what this is. The last year has been spent getting to know our partners. And Hope, if we transition to the last slide there, I'm very, very proud of this, as we all are, as a member of this partnership, to showcase that CI Private Wealth is currently composed of 9 operating committees, as well as an editorial board. So if I look at the composition of these committees, certainly Dale Yankee at the helm, as a member of the Strategy and Governance Committee. I'm fortunate to chair the Client Experience Committee Obviously, Will representing just what he spoke to in terms of a member of our investments committee, Brett Pernicano within business development, Greg Richardson leading nationally on the financial planning front, and of course the editorial board. Hope, we're so grateful to have you on that team alongside Matt Adams and Grant Webster. It makes me very, very excited to think that not only do we have a strong partnership in place, redundancy throughout our firm and now nationally, but really what is possible when you bring around the best and brightest minds in our industry under one umbrella, which in fact is CI Private Wealth. So very, very excited for the future. I would say if we are more excited today than we were even 1 year ago when we embarked on this journey. And I'll say today what I said a year ago, the sky's the limit.
Always good to end on a high note. I know, markets and the economy are a little bit challenging, but we're in great stead with our sister firms with CI Private Wealth. Very excited about that. Thank you so much, Mark, for giving us some more insight into that. For everyone on the webinar, thank you very much for attending. Here are our disclosures. We're going to pull up for a minute for some additional information. If you have additional questions or you would like to talk about anything that came up today further, please do reach out to your team at Dowling & Yonke. We're always happy to have that conversation. Mark, Will, thanks so much for your time.
Thank you, Hope. Thank you, everyone.